Hello there. Today, I will be discussing about the accounting cycle. Because accounting is all about getting data and putting them into the accounting equation, the end products are financial statements such as a balance sheet and income statements. The process of accounting follows a cycle called the accounting cycle. So the accounting cycle is a step-by-step process of collecting, summarizing, recording, and presenting financial information, right? So it starts with the identification of whether a transaction is accountable or can be quantified and ends with a post-closing trial balance. Okay, now, let's go to the process. So step 1, analyze business transactions. Okay. So in this step, a transaction is analyzed to find out if it affects the company and if it needs to be recorded. Okay. So first, you carefully read the description of the transaction to determine whether an asset, a liability, an owner's equity, a revenue, an expense, or a drawing account is affected. Next, for each account affected by the transaction, determine whether the account increases or decreases. Okay, and third, determine whether each increase or decrease should be recorded as a debit or a credit, following the rules of debit and credit. Okay. So to better understand that step, right, take a look at this example. Okay, for example A, on August 15, 2020, Lila Doe resigned from Company X. So this does not affect any asset, liability, or the owner's equity account. So the resignation of Lila Doe from the company does not affect the financial statements of the company. All right, now let's go to transaction B. On December 2, 2020, VEEN purchased 1,000 pesos cash worth of supplies at ABC Hardware. All right. So this affects cash and supplies. So both asset accounts. Right. Now, before we go to step 2, let me first discuss to you the chart of accounts because this is important for the following steps. So chart of accounts is a list of all general ledger accounts being used by a company. The purpose of maintaining a chart of accounts is to keep things organized by specifying an account for each type of transaction and to avoid misclassifications while posting general entries. So in order to keep things simple, a predefined numbering scheme is used to differentiate between different categories of accounts. So the most commonly used numbering scheme use prefix 1 for assets, 2 for liabilities, 3 for equity, 4 for incomes, and 5 for expenses. Okay, so example this one, the chart of accounts. So as you can see here, the account number is 100101. So that is for cash on hand. So cash on hand, cash in bank, accounts receivable, and fixed assets, they are all assets. So the account numbers start with 1. Accounts payable is a liability. So its account number starts with 2. Right? And also with notes payable, a liability. So it starts with 2. Okay. Share capital, a capital account starts with 3. Revenue and other income. Right? So revenue account starts with 4. Expenses accounts like salaries, utilities, and cost of goods sold so starts with 5. All right. So this is just an example of the account numbers. So the company has the choice of the accounts that are to be used for each account. But, right, most common is assets would start with 1, right? Liabilities with 2, capital with 3, revenues with 4, and expenses with 5. It just differs for the, okay, number of digits here, right? Because big companies usually have 10 digits for their account numbers. Okay, now let's go to step 2. Record this in the journal. So using the rules of debit and credit, transactions are initially entered in a record called a journal, and the entry made is called a journal entry. So the journal serves as a record of when transactions occurred and were recorded. For repetitive transactions or high volume transactions, example 1,000 sales transactions in one day, special journals are made. So these special journals include sales journal, purchases journal, cash receipts journal, and cash disbursements journal. All right. So example A. On August 15, 2020, Lila Doe resigned from Company X. So there's no journal entry for this transaction. Okay. So for example B, I want you to focus your attention on this example because we will be using this transaction for the entire steps, okay, of the accounting cycle. So on January 1st, Wendy, the owner, invested 600,000 pesos to its information services business. On January 5th, equipment obtained through financing from bank, 500,000 pesos. January 10th, paid rent for 2 months, 20,000 pesos. January 10th again, company rendered services and collected the full amount of 400,000 pesos. January 14th, the company rendered services on account for 250,000 pesos to a major customer. Now the entire amount is to be paid by the customer after 15 days. On January 25th, the company rendered services of 100,000 pesos. The customer paid 30% of the total amount and was given 15 days to pay the remaining balance. On January 29th, collected from January 14 customer 250,000 pesos. January 29th again, paid employee salaries of 20,000 pesos. And January 30th, estimate of electricity bill for January 25,000 pesos not paid. Okay, so now we are going to journalize the transactions. Okay, so we have here the date, the account description, the post reference, the debit, and the credit, right? So the post reference here indicates that this transaction for the journal is already being posted in the ledger, all right? So posting in the ledger is the next step after journalizing. Okay, so here the post reference here 100,100. So this is the, as you can observe, the account number for this account. Okay, so on January 1st, 2021, capital invested by the owner. So that is cash, debit cash of 600,000 pesos. You credit capital of 600,000 pesos. And then you put annotation so that, okay, you would immediately know the type of the transaction. On January 5th, purchase of equipment through financing from bank. So that is equipment as is asset, so debit 500,000 pesos. And you credit long-term loan, okay? Because financing from the bank, right? Credit 500,000 pesos. Now, on January 10, 2021, payment for rent for 2 months. Okay? So, that is prepaid rent. So, prepaid rent is an asset, right? Because you already paid the rent, but you have not actually incurred it yet. So, 20,000 debit, you credit cash for 20,000 pesos. Now, on January 10, revenue from services rendered. So you receive cash for your services rendered. So you debit cash of 400,000 pesos and you credit service revenue. So we use here service revenue because the nature of the business is service. All right. Okay. January 14, revenue from services rendered on credit terms, right? So on credit terms means that the customer did not pay in cash. So if you can remember, the customer was given 15 days to settle its account. So you record accounts receivable debit 250,000 and credit sales revenue of 250,000. So on January 25, revenue from sales rendered on credit terms. Okay, so if you can remember, the service revenue was 100,000 pesos and 30% of that was paid in cash and the remaining 70% to be settled after 15 days. So what is 30% of 100,000 pesos? That is 30,000 pesos. So you debit cash of 30,000 pesos and also debit accounts receivable of 70,000 pesos. Okay, now this is an example of a multiple entry. So you have two debits and one credit. Okay, on January 29, you receive payment from credit customers. So that means that the customer from January 14 already paid. Okay, on January 29. So you receive cash. Now you debit cash of 250,000. So you credit accounts receivable of 250,000. So your accounts receivable here on January 14, debit. So you credit on January 29. So that is already closed. Now again on January 29, you pay your employees' salaries. So salaries expense, debit 20,000 pesos, you credit cash 20,000 pesos. January 30, booking of accrual for electricity expense. Because according to the transaction, you estimated an electricity expense of 25,000 pesos, but you have not actually paid it yet. All right, so you just record it as accrued expenses. Okay, so that's for the journalizing. Now, let's move on to step 3, which is post the transactions on a ledger. So a transaction is recorded in a journal like we did previously. Periodically, the journal entries are transferred to the accounts in the ledger. The process of transferring the debits and credits from the journal entries to the accounts is called posting. So ledgers provide chronological details as to how transactions affect individual accounts. Chronological, so January 1, January 2, January 3, until January 31. So there are two types of ledgers, the general ledger and subsidiary ledger. The general ledger is a summary of the different subsidiary ledgers and can serve as a control account. For example, a general ledger for accounts receivable summarizes the balances found in the different subsidiary ledgers for different customers. Okay, so take a look at this example. D. Lucky, a CPA, is an independent auditor with only 2 clients. The accounts receivable ledger account has a balance of 100,000 pesos. So this is an example of accounts receivable ledger. This is the general ledger for accounts receivable of 100,000 pesos, the balance. His two clients are A. De la Cruz and B. Santos. Okay, so this is the subsidiary ledger of client A. De la Cruz and client B. Santos. So the subsidiary ledger of A. De la Cruz has a balance of 25,000 pesos. B. Santos ledger is 75,000 pesos. Okay, so the sum of subsidiary ledgers must total the general ledgers, or else there must be an investigation to identify the source of discrepancies. So here we have 25,000 plus 75,000, so that totals 100,000 pesos. Okay, so this is an example of a general ledger. So general ledger of cash, so this is taken from our transaction for VEEN information services business. All right, so general ledger, cash. Now the account number is 100, 100, 100. So we have here the date, the description, the post reference. So the post reference here means that this transaction was taken from the general journal page 1, okay, from journalizing of entries, debit, credit, and the balance. So on January 1, 2021, capital invested by owner. So from general journal page 1, debit 600,000 pesos. So you have a balance of 600,000. Okay. So on January 10, payment of rent, right? So you credit 20,000 pesos. So you deduct 20,000 pesos from 600,000 pesos. So that is 580,000 pesos. That means that on January 10, 2021, you have a balance of 580,000 pesos for cash. But then on the same day, you receive cash for services rendered of 400,000 pesos. So you add 400,000 pesos to 580,000, that makes it 980,000 pesos. Now on January 25, you receive cash for services rendered, 30,000 pesos. So if you can remember, only 30,000 pesos was received because the remaining will be paid after 15 days. So 30,000 pesos plus 980,000 pesos is equal to 1,010,000 pesos. Now, on January 29, you receive cash from credit customers of 250,000 pesos. So, your total balance for cash is 1,260,000 pesos, right? So, on January 29 again, you pay your employee salaries. So, you credit 20,000 pesos. So, the balance at the end of the month is 1,240,000 pesos, right? So, for the accounts like accounts receivable, capital account, you make general ledgers also. Okay, so that it will be easier for you to, okay, to make your financial statements, right? Now, let's proceed to step 4, which is prepare an unadjusted trial balance. Okay, so why you need to make an unadjusted trial balance? Because errors may occur in posting debits and credits from the journal to the ledger, from step 2 to step 3. So one way to detect such errors is by preparing a trial balance. So double entry accounting requires that debits must always equal credits. The trial balance verifies this equality. So these are the steps in preparing a trial balance. First, you list the names of the company, the title of the trial balance and the date of the trial balance. List the accounts from the ledger and enter their debit or credit balance in the debit or credit column of the trial balance. Third, total the debit and credit columns of the trial balance. Fourth, verify that the total of the debit column equals the total of the credit column. Okay, so you write the name of the company, VEEN Information Services, and adjusted trial balance for January 31, 2021. So account description here, debit, credit. Now, Vendi Capital, the balance of 600,000 pesos. Long-term loan, 500,000 pesos. Accrued expenses, 25,000 pesos. So you have equipment of 500,000 pesos. Accounts receivable balance, 70,000 pesos. Cash of 1,240,000 pesos. So the cash balance here, if you can remember, this was taken from the cash ledger, right? The running balance of cash, so that the balance of cash at the end of the month is 1,240,000 pesos. Prepaid rent of 20,000 pesos, sales revenue of 750,000 pesos, staff salaries 20,000 pesos, and electricity expense of 25,000 pesos. So you total the debit side, so that is equal to 1,875,000 pesos, and you also total the credit side, and it is equal to 1,875,000 pesos. So your debit and your credit is balanced. So that means our journalizing and posting to the ledger is correct. Okay. Now, for step 5, you make adjustments. Journalize adjusting entries. Okay. So at the end of the accounting period, many of the account balances in the ledger can be reported in the financial statements without change. For example, the balances of the cash and land accounts are normally the amount reported on the balance sheet. However, some accounts in the ledger require updating. This updating is required for the following reasons. Some expenses are not recorded daily. Some revenues and expenses are earned as time passes rather than as separate transactions. Some revenues and expenses may be unrecorded. So the analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. And the journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. Okay. So the following are normally adjusted at the end of the period. Okay, take note of this. What should be adjusted at the end of the period? Accruals. These include unpaid salaries for the accounting period, unpaid interest expense or unpaid utility expenses. The prepayments. If a company has prepaid expenses such as prepaid rent or prepaid insurance, then the correct balances for these accounts have to be established at the end of each accounting period to reflect their correct balances. Depreciation and amortization expenses. Depreciation expenses are recognized at the end of each accounting period through adjusting entries. If there are intangible assets such as franchise, the allocation of their cost, which is called amortization expense, is also recognized at the end of each accounting period through adjusting entries. Okay? And the allowance for doubtful accounts. Okay. So bad debt expense from accounts receivable is also recognized through adjusting entries. Okay. Now take a look at this example. So from our VEEN information services, we have already accrued interest expense, electricity expense. So let's move on to the other adjustments such as prepayments, depreciation, and provisions. Now assume the following adjustments. First, adjustment of prepaid rent for 1 month. Okay, 10,000 pesos because, okay, if you can remember on January 10, we paid 2 months rent worth 20,000 pesos. So at the end of January, now you adjust the rent. Okay. Second, adjustment for depreciation expense. All right. So assume a useful life of 5 years for the equipment and a depreciation rate of 20%. So the depreciation for 1 month would be 500,000 pesos times 20% times 1 over 12. That is equal to 8,333.33. Now, recognize a provision for doubtful receivables at the rate of 10% of outstanding receivables. Right? Because we cannot be sure that the accounts receivable will be collected in full. All right. So for, okay, to be safe, we just make a provision for doubtful receivables. Okay. So the accounts receivable balance for VEEN company is 70,000 pesos. So 10% of that is 7,000 pesos. Okay, now we are going to journalize that one. So date, January 31, 2021. So you use the end of the month because that is where you are going to make adjustments. So rent expense, 10,000 pesos debit. So you credit prepaid rent. Now your balance for prepaid rent is 10,000 pesos because 20,000 pesos minus 10,000 pesos for the month of January. So your balance for prepaid rent now becomes 10,000 pesos. If you make the trial balance, you can see that later. So you write the notes here, adjustment of 1 month rent in prepaid rent account. January 31, 2021, depreciation expense of 8,333.33, accumulated depreciation of 8,333.33. So purchase of equipment through financing from bank. Again, on January 31, 2021, debit provisions accounts receivable of 7,000 pesos and your credit provision against doubtful receivable of 7,000 pesos. So, provision for doubtful receivables. All right, so this is how your adjusted trial balance looks like. Okay, and that is the step 6. You prepare an adjusted trial balance. Okay, so Vendi capital 600,000 pesos, the same. Long-term loan 500,000 pesos. You have not paid your loan to the bank yet. Accrued expenses of 25,000 pesos. Okay, so your accrued expenses now is credit because you have already, okay, expense your electricity, right? Okay. Equipment, 500,000 pesos. Okay, and you have now the accumulated depreciation of 8,333.33. Accounts receivable, 70,000 pesos. Provision against receivables, we have 7,000 pesos. Cash, the same, 1,240,000 pesos. So your prepaid rent is now 10,000 pesos. Okay, because you already expensed the 10,000 pesos. Okay, so you have now rent expense of 10,000 pesos. Sales revenue, 750,000 pesos. So you have depreciation expense of 8,333.33. So salaries, the same, 20,000 pesos. All right. So your total debit is now 1,890,333.33. And your total credit is 1,890,333.33. So it's balanced. Right. Now, step 7 is prepare the financial statements. Okay. So, right. So, a complete financial statements include the balance sheet, profit and loss account or income statement, cash flow statement, statement of changes in equity, and notes to the accounts. But for this video, okay, I am just going to show to you the income statement. Right? So this is how it looks like. Vendee Information Services income statement for the month ended January, okay, 31, 2021. Sorry, this is January 31, 2021. So service revenue, 750,000 pesos. Okay, expenses. Rent expense, 10,000 pesos. Salaries expense, 20,000 pesos. Depreciation expense of 8,333.33. Provision for doubtful receivables, 7,000 pesos. Electricity expense of 25,000 pesos. So the total expenses is 70,333.33. You deduct this from 750,000 pesos, your service revenue. So the income is 679,666.67 pesos. Okay. So step 8 is make the closing entries. Upon closing, if the revenues exceed expenses during an accounting period, retained earnings will increase. The reverse is true, which means that if the expenses exceed revenues, the retained earnings will decrease. In closing temporary accounts, revenue account balances are transferred to an account called income summary account, sometimes profit or loss summary. Okay. Expense account balances are also transferred to the income summary account. The balance of the income summary, net income or net loss, is transferred to the owner's capital account. The balance of the owner's drawing account is transferred to the owner's capital account. All right. So step 9 is make a post-closing trial balance. So what is a post-closing trial balance? It shows the accounts that are permanent or real. These are the accounts that can be seen in your balance sheet. And the post-closing trial balance is prepared to test if the debit balances equal to the credit balances after closing entries are considered. Okay, so that's all for the accounting cycle video. Okay, thank you so much for watching the video. I hope that you learned something from this video. Okay, thank you.